Financial statements analysis is not without problems and limitations. It will do an analyst well to be aware of and guard against those problems. One is with regards to percentage increases and decreases. There are instances when the percentage change seems too large or too small, which could be misleading. Consider the following figures. Notice that expense A increased by a huge 300%, while expense B decreased by only 10%. However, the manager of the company should not worry much about expense A, although the increase is 300%, because in terms of absolute amount, the increase is only 2,100, which is quite immaterial, insignificant. Neither should he be disappointed that expense B decreased by only 10%, because in terms of amount, the decrease is quite large, 120,000 pesos. In other words, to overcome the problem with percentage increases and decreases, the absolute amounts must also be taken into consideration. Furthermore, when the base figure or the amount of the earlier period is zero, the percentage increase or decrease cannot be computed, because any number divided by zero is undefined. Analysts must also be mindful of the differences that exist between entities that they are trying to compare. A ratio that is acceptable to one company may not be acceptable to another, considering such factors as the nature of business, the business environment, and the economic and political conditions where the companies are located. Diversification within entities, meaning operating several unrelated business segments, also limits the usefulness of financial statements analysis. Segment data may provide more relevant and comparable information. The differences in accounting methods used may reduce comparability. One entity may use the straight line method of depreciation, while another may use the sum of years digits method or the units of production method. One company may determine the cost of its inventories using FIFO, first in, first out, while another may use the weighted average method. There is also the problem of differences in estimates, as well as the possible inaccuracy of the estimates. A certain equipment may be estimated by one company to have a useful life of 10 years, while another entity may set its life at 15 years. One firm may estimate doubtful accounts using the aging of accounts receivable, while another may use the percent of sales method. Moreover, when the estimates are inaccurate, the affected accounts which appear on the financial statements, the percentages, and the financial ratios will also be inaccurate. Another one concerns valuation. Financial statements are based on historical cost and do not reflect the current market value of the entity's assets. And remember the stability of the currency assumption. The accounting function is to account only for pesos or dollars or euros, as the case may be, and not for changes in the purchasing power of money. Price level changes, inflation and deflation are not accounted for. Some end-of-period data may be atypical, meaning may not represent normal business conditions. Then there is the use of averages. Although, as pointed out in previous parts of this lecture series, the use of an average figure in certain ratios is better than end-of-period amount, most of the averages are calculated by simply dividing the sum of the beginning and ending balances of the account by 2, which may not really represent the outstanding balance of the account throughout the accounting period. In the second part of this video series, I mentioned the suggested remedy to this problem, and that is to use, whenever available, the quarterly or even monthly balances. But even then, the resulting figures are still averages, which are mere approximations. Another problem is lack of information. Financial statements do not show all the details needed by external analysts in determining some ratios. For instance, the formula for accounts receivable turnover requires the use of the net credit sales. However, financial statements do not normally provide the breakdown of the sales into cash sales and credit sales. Similarly, the accounts payable turnover needs the amount of the net credit purchases, but the breakdown of purchases into cash purchases and credit purchases is not shown in the financial statements. In such cases, analysts just use the net sales and net purchases figures, which undoubtedly affect the resulting financial ratios. Moreover, some expenditures are recorded as expenses when incurred, rather than capitalized as part of the cost of intangible assets, which can drastically underestimate the value of a company, such as when a large sum of money has been spent to build up a brand image.